Welcome to the Capital Discussions Roundtable. This is a special roundtable on Friday, the 23rd, October 2015. Jim Riggio is on. We're going to be talking about the Kevlar, but before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as slippage and commissions. This is at our web pages if you care to read it slowly and at your own pace. With the way, welcome, Jim. I know your schedule recently has been challenging, but it's nice to have you back on.
Thank you, Tom. Yeah, no, it has been. A lot of my days have been, really booked, and there's travel involved in my new role, and so it's not as easy to do these as I used to. But I've been showing up with Kevlar Trade. I ended up trading mine somewhat different than I know that Himanshu had actually, he and I had talked about this when I first started, and I'm trading this many years ago. It had to be about 4 or 5 years ago at this point when I ended up showing this. I originally presented this over at the SIBO. I know that other people have looked at it and traded it. I know that Himanshu is probably the one who ended up doing the most work on things. What I figured we'd end up doing is I just go over quickly the concept of the trade. It is more of a concept trade, not a specific rule trade. But I wanted to be able to end up going through that with you. So I'll give you the logic behind everything, and then what I'll do is, I'll end up answering questions if you guys have any in and around it. I made an adjustment today. Tom, did you post those yet, or are they going to be posted later on?
I already posted them.
Okay. So basically, here's the whole concept of the Kevlar. The Kevlar, depending on how high implied volatility is, and more importantly, the level of the skew. Now, if you guys remember, skew was how high implied volatility was on different strikes. So if I end up just coming over here, I'll show you, we take a look at the December. Let me pull this thing down. I always keep...
Again.
Oh, you know what it is? It's going to be when I move my mouse because I'm on the VoIP line. Okay, so I end up realizing it should be okay when I'm not on the scene.
You need to share your desktop. When I gave it back to you, you need to reshare.
Oh. Sorry about that. Okay, you should be able to see this. The concept of the Kevlar, a butterfly that may or may not have a broken wing. When I started this a few weeks ago, the implied volatility of the puts near the money compared to the implied volatility of the puts below the money was relatively low, on a historical basis. So when I ended up starting this trade, and you guys may have seen this, I guess that went out probably about 2 weeks ago. This was the trade that I put on. It was a butterfly. I like to use irons, okay? And the reason why I like to use irons is that I collect money when I sell an iron butterfly and iron condor. For in life, a lot of people will trade this off of just owning FPY shares. If I use puts, I have to have cash available to pay for the put butterfly, which means that I'd be able to buy a lot less shares. If I use irons, I am collecting money, and I can end up using that to buy more shares. So basically, people say sometimes, well, interest rate is calculated into the options. Yes, it is. But if you're an average Thinkorswim user or an average IB user, and I realize IB is a lot better, or LiveVol, those will end up having the interest rates used in calculation in the options is the risk-free rate, which is, like 1/4%. Whereas if you're borrowing money and paying interest on margin, you're probably paying 4 to 6%, maybe higher in some places. So I'd much rather always end up paying a lower rate. So therefore, I'll end up using irons. Does it make a difference? In the end, your execution is going to be similar. To me, I haven't seen it. I've traded irons so long that I just kind of end up knowing. One of the challenges that people will end up having, they won't understand the math sometime behind things. It's since this is going to end up being 100 points, it's pretty easy to end up just doing the math, and I'll show you how to end up doing it, how you can end up converting it out, and what a put butterfly would end up being versus say a call butterfly versus an iron. Anyway, the trade that I started with, okay, was a broken wing fly. I use broken wings whenever the implied volatility of this put here isn't significantly different than this call over here. When you take a look at, because that's the largest range, I'll also always look at them at relative to the center point. But you take a look at it, so how do you end up taking a look at it? And I'm not going to go through the whole thing, okay, I don't have enough time now, but I end up using, probably LiveVol has the single best history of skew. We use an institutional tool called Vol Edge and Risk Edge. But let me end up showing you what I mean by this. So if I take a look at the 2025, and what we'll do is to compare apples to apples so you can see everything. Let's just take a look at the implied volatility of the 25-25 is 16.12. If I take a look at and I'm going to need a lot more strikes because the market's moved so much. Not 1,400, let's just try 100. And if I look at that versus the 1850, it's 21. So there is a significant difference right now of 5 vol points. We were not at 5 vol points when I put this on. When the vol are lower, think about what I'm doing here. What I'm doing is I'm kicking out my long strike, and instead of using a 75 point, using a 100-point wing. So when I was doing this, basically what the difference is, am I using the 1875 or the 1850? Okay, that's really the difference. And I'm taking a look at the overall skew on things, but the difference is, do I end up kicking it further out? So am I going to pay $8.40 versus $9? I end up taking a look at that. I'll always take a look at the price, and it was much, much closer when I put it first on. Instead of there being close to a point, it was a half a point when I put these things on. If I end up going back so that you can end up seeing the risk chart, the risk chart. This was the trade that I initially put on. When I put these things on, I like them to end because I don't have a real worry about it running out here because my risk is so much lower. So when I ended up buying the call, the in-the-money call, and you can see I don't like to buy them when the implied volatility is this low. And this is another very important point on the trade. When the implied volatility, okay, is low overall, like we kind of were, and the skew isn't that bad, I don't like to go too deep into the money because what ends up happening is that if we pull back, okay, and I was afraid of that, I'll get a much bigger jump in volatility if I'm using a call closer to the money. Okay, so I ended up using the 2000. For those of you who haven't been following along, by the way, on the option view charts that Tom's been posting, I use a 10-to-1 ratio. So I've been posting this for people to use less than $5,000. So when I ended up doing this originally, I'd wanted you to use 1 SPY, not SPX, 1 SPY call to 1 SPX butterfly. That's a 10-to-1 ratio. So if you take a look at the stuff that we're going to be using in option view, I couldn't show it that way because I couldn't end up showing SPY and SPXs. I couldn't use fractions like I use here or decimals. So we just multiplied the trade by 10, okay, just for years. Anyway, you can end up seeing that over here, and I didn't have a lot to worry. I wasn't going to be sagging for quite some time. So if I come and I show this to you instead of on days, I'm sorry, instead of on expirations, if I show you this on a 2-week chart, you can end up seeing the implied volatility, and I could go back but we ended up having this move up quite, nicely without a lot of risk. Could I be taking more money if I put the butterfly up tight? Yes. Would I have more management challenges? Yes. Am I traveling a lot and am I busy? Do I have a lot of time to end up doing this during the day? No. So I wanted to end up having a safer trade. You can end up seeing as we ran up, by the way, right, another quick point. You can see as the lines go up every 2 weeks, this means I'm going to have some really nice positive theta in here. Over here, I'm going to have negative theta when we've moved up this high. And you can see that this trade was negative theta. It was also positive vega. Now, like I said, I'm not very worried if I'm above the market, above my long strike in a broken wing configuration. When I use a regular butterfly, I will be concerned, and I will end up adjusting it. I got a couple of emails saying, my Vega's gone positive. Isn't it time to adjust? And the answer was, no, I'm not really that worried right now. I'm not going to get crushed here because if we continue to run up, I was going to get more and more positive delta. So there wasn't a lot to end up worrying about. Now, what ends up happening is that when you have run up like we've had, sometimes I've seen boomerangs, right, where it runs up and then it flames back out. And I didn't want to end up adjusting too quickly because it was so early in the trade. Later in the trade, it's a little bit different story, right? If we're in the last, 3 weeks, yes, I wouldn't, or last month, I would have done something. But I had plenty of time early in the trade. Tom, you've seen this. Any questions from your side or from anybody in the audience at this point?
We did have a couple questions. Dave Stewart says, Jim, which vol numbers do you use? Live vols or TOS? Is there usually significantly different? Not to even bring up option view, which usually has different vol numbers yet again. And he said he personally uses live vol to stay consistent.
I do. Not a lot of people use live vol. You can't end up keeping track of your history of your trades here, but this is actually traded on live vol, and I use live vol numbers. Okay, and I know we could end up having a 3-hour discussion on the difference between the vols, which, if you go back, I know we have some, in our archives. I don't want to have that now, but I use live vol. It's the one that we think is probably most accurate.
Okay, and then Dave mentions that the straddle is around $90 for December, just for reference.
Okay, yeah. That's another thing that people end up looking at. If you're not sure, if you don't know whose numbers to end up using, if you look at the cost of the straddles at the money, it'll give you a feel for it. The other way you can end up getting a feel for it is just to take a look at the overall VIX futures, right? That's another one. If you just want general high-level stuff, what that doesn't give me, that doesn't give me skew. And I care more about skew. If the implied volatility is very, very low overall, but the skew is steep, meaning that the puts below the money are much more expensive than the puts at the money, I'm not going to use a broken wing. I like using broken wings when implied volatilities are higher or preferably end when the put skew is very shallow, meaning that the puts below the money aren't all that much more expensive in terms of their IV level than what is at the put at the money. So you take a look at the strike, and what I end up doing is I look at the strike where I'm going to be going. I look at deltas too, but I would much prefer, to look at a percentage below the money than at a delta, because this way I know what I'm looking at on a consistent basis. The other one, right, if I use delta, it's variable. Anyway, so this is what the trade ended up looking like. So there wasn't a lot to end up moving. We had that huge run up yesterday. By the way, I couldn't trade even if I wanted to yesterday because I told you I was busy. But today I thought, okay, it was time to end up making adjustments. Now I wanted to end up showing you, let me go back to the expiration graph. Oh, by the way, some people, I did say this for the emails that I got about volatility. Here was my Vega. So I know that we had run up, but in terms of just the movement, not if volatility moves. That I understand if you go through a vol crush, it ends up changing. But how much did my Vega change? As we moved up, yes, I did get positive Vega, but it was manageable, right? We're already relatively low, so I didn't think we were going to end up getting a vol crush down to 8 at this point. Right, so the damage was kind of done. I was already positive, okay, some money on this. I'm only using under $4,000. I was up 150 bucks. So my percentage is, it's reasonable. My goal here was to end up making $500. So there's no need to move very quickly on this thing. That was another thing that was important. I did a video last weekend where I ended up kind of going through. Let me go to the expiration graph so I can end up just showing you. I know most people like this, not Vega, but open. I took a look at it. One of the ways to end up making an adjustment if you run up is to take your long call and roll it back, roll it to a higher delta. Remember, not for you M3 traders, this isn't really an option because you're already starting sometimes with a 90 delta. What are you going to roll it back to, a 93 delta? I started with like a 60 delta, a 64 delta, I think it was, an option two. So if I roll it back, I know we run up and I got a higher delta. It's moved up naturally because the market's moved up. So one of the things that I could end up doing is that I could have rolled it up. It ends up helping with the chart a little bit. It keeps me flat. The other thing I can end up doing is that I can end up rolling higher. So I would take my long put, I would roll it up. Some people call that a reverse hobby because I'm taking risk off the table. Right? Topic for another presentation another day. About reverse harvests. And I would take my short call and I would roll it higher also. I like to think about which directions I know some people think, well, a put credit spread versus a call debit, and to me, that just confuses people. It's a lot easier to see on the graph. I'm taking this option, happens to be a put, doesn't matter what it is. I'm taking this option, I'm rolling it up. I'm taking this short option, I'm rolling it higher. And that would end up being into a contract. And if we had moved up and we had stayed in this area, that would have been a nice trade, but the problem is that we've blown through all of this. Right, we've blown through all of it, so I need to end up rethinking my adjustment. The other thing that I ended up talking about is, and again, I like this adjustment only on broken wings, not on even wing butterflies. But one of my adjustments, if we go down, is to end up buying a vertical. Okay, it moved too far. So I had to rethink everything. So this is what I ended up thinking about doing. It had moved so up, it had moved so far up that there really wasn't an option. I didn't see an option or an alternative that I could end up doing with this trade other than taking the whole butterfly off and repositioning. So that's what I did. I closed it. Now, when I take a look, okay, so and if I unclick that, you can see that by rolling it up, I lost $160 on what I had rolled. You can also end up seeing that on the call, okay, we were up $300. So overall, you could see that, and granted, this is it was a little bit less, okay, when I rolled it, it was up about $140. And so these two actually cancel one another. So now it's time for a new trade, okay? So here was the butterfly that I looked at. I wanted to do it even because the skew is pretty significant. The challenge is that this is very negative in terms of the delta. If you take a look at your delta for this level of butterfly, 75-point wing butterfly, it was rather, I'm sorry, I said 75 points, and I meant 100. It was rather steep. So when I take a look at the one call I had, okay, I ended up, the one call, if you take a look at it, right, I was minus 22. With this, I'm minus 14, so it was only a third. So I needed to have more oomph. I could have easily put 2 on, but because we had run up so much, I wanted to have extra room to the downside. Again, it's early in the trade. If we run up, I don't have a big issue. So I wanted to end up being a little bit more conservative on the downside. Let me put these in so I have my right P&L. Okay. So my P&L was that I'm only up $120. It did cost me a little bit to end up going, but and why did I use a even butterfly instead of a broken wing butterfly? And it was because the skew was so different between the at the money puts versus the below the money puts. So because we were steeper, remember when the skew is steeper, we're not going to end up going out and buying even a higher implied volatility. We're going to end up buying a more reasonable volatility. So I'll end up keeping that trade. The other thing is that when the IV is this low, I know a lot of you M3 guys really like to buy, those 80 to 90 deltas. I would rather buy more deltas closer, because what ends up happening is that if the market pulls back, volatility is going to end up jumping up. And if volatility jumps up, having the long calls closer to the money will end up having their Vega affected much quicker and will make money quicker. Okay, so that's why I chose this. I am still negative. You can see, by the way, had I bought two of them, let me just show you if I would have bought another one, because I would have taken my deltas practically to zero. But the fact is, after we've run up so much, I didn't want to have my deltas be flat. I wanted to have my deltas be a little bit negative so I had more room if we pulled back. Tom, that's pretty much the trade, all right? I don't know if there are more questions. What I'll end up doing is that at least, twice a week, more sometimes if I'm traveling, I'll have to end up kind of doing a longer range one where I did one over last weekend and I did it this Friday. But I'll try to end up updating this. Tom, I give you the trades when I make them. I know that you put them in option view. I do cut and paste. I haven't cut and pasted these yet, but I'll cut and paste them. And I'll give them to you, Tom, so you can put them also in the log. And that's what it is. What I'd like to end up doing now is, answering any questions. People a lot of times say, well, what would you do if this, or what do you do in this, or what happens if the implied volatility is lower or higher? So. Okay, go ahead, Tom.
America said, do you have any live trading statements or detailed back tests? How long has you been trading this?
I got asked that question. The answer is yes, and because this was traded, in a fund, for a registered investment advisor, I'm not at liberty to share it with you.
Okay, I guess the answer is yes, it has been traded live, and presumably it's been doing okay because you kept trading it, so we'll just go with that because that's all we can do. Chuck says, do you typically like to buy your calls at 60 delta? Are the conditions where you would change that due to skew or deltas needed?
Yes, and the answer is no. 60 just happened to be a number that we use this time. What I end up doing is that I'll look at ranges. I kind of take a look at the that well below the money, that 80-plus number, then versus a little bit in the money. And a little bit in the money might be, the mid to upper 50s to low 70s, okay? And I look at it for deltas. I'm really trying to get my deltas in shape. And so a lot of times the question might end up being, where can you end up putting it in terms of, do you want to zero out your deltas? In this case, had this been a brand new trade and I hadn't put anything on, might I have put in three? I could have put in 2 or 3. I chose to end up having more room to the downside. This is why I say I don't have rules. Other people might say, Jim, you're an idiot. It's definitely going to keep going up. How could you be negative? You should have put in 3 or maybe even 4 calls. You can do that. You can do that. And I'll show you. I was looking at this stuff before, but if I end up showing you, I keep a lot of my charts. I'll keep different lines that I've drawn. These lines were drawn, 3 years ago. Look at this one line that was drawn 3 years ago. It was drawn from 2011 to the low that we had in 2012. It happened to be an incredible support right there. When we broke it, we sold off. And look at this. Today we went above it. Will that line go from, it went from support to resistance? Will it go back to support? I don't have a clue, but this is what I do think. I think that the last time we ended up having something like this, this huge sell-off or run-up, okay, then we ended up challenging the peak of before we sold off again, and this time it was multiple years. We had a lot of static there for a while, for several months, before they tried to break it, and then they finally got back above it. So as much as we've moved, might we have found an area? Okay, and here, let me show you another one. Drawings, let me go to 2. I like this. Here was a Fibonacci that I ended up drawing, okay, when we had the sell-off in October to the first peak that we ended up having in December, okay? And you can end up seeing that the sell-off, by the way, boy, that Fibonacci was nice, and we tested it twice. What I also ended up doing after this, because I wanted to keep that one, I drew another Fibonacci. No, was it this one or was it 4? It was 4, sorry. Oh, 5, that's what it was. I drew another Fibonacci up to here. Okay, and this was the high that we hit from the low in October to the high that we ended up hitting in May. I also take a look at, I had drawn this line some time ago when we first got there. This was the high after the bounce from October to December. And to me, it seemed to be like a real battleground, because the thing is, we tried to pass it, we went down, it ended up, we were below it, and you can see every time we moved it, we kind of ended up moving to one direction or another. It held a few times, they tried to break it, and then once we broke it, we really sold off, and we're back up to it again. So at this point, I kind of took a look at it. Today was a good day to make the adjustments. I don't know which way we're going to end up going, but I do know that the vol is low, the skews are relatively steep, so when I ended up going back to my graph, okay, and taking a look at, oh, not this one down here, okay, and putting on the 2, I'm sorry, the 2, not the 3. All right, this is 10% up, 10% down. Okay, I kept my risk again. Remember I told you I was going to use under $5,000, so I'm using under $4,300 at this point. I'm comfortable, right? I'm comfortable with this. So, Tom, next question. That was
okay. David asked, can you buy front month long call hedge to get closer to the money for less data in November instead of December?
Without question, you can. Some people love to buy the front week because the thing is that they can spend a lot less money on it. Now, here's the challenge with it. It doesn't hedge my Vega. I'm saying yes without question from Delta and Gamma, not so much for Vega. Whereas if we get a pullback, if we get, a sudden, let's say, 70-point, 100-point pullback in the SPX on Monday or Tuesday, that front week, okay, you're going to make some Vega dollars, and yes, the implied volatility is really going to end up shooting up, but now I have to end up, I'm making a bet on the difference between, well, hopefully the front week volatility will shoot up so much to be able to help to offset those Vegas in the back month. And let me go back and show you what I'm talking about specifically, because some people, okay, don't realize this. Okay, so let's use my center strike. Let's use the not the center strike, the call strikes that we have here. So my 2000s. Right, my 2,000 calls in terms of Vega are carrying 274. I could use the front month, and let's use a week 2 just so that you can take a look at it. Okay, for week 2, instead of nearly just under $3, right, I'll call it, 275. I'll round it to the nearest quarter. Okay, look at what my Vega is here, 37. If I use the front month, okay, where's the 2,000 here? $1.60, right? A lot better. Okay, so I know people who like this strategy like to go up really, really close because you're not paying a lot for theta. Okay, and it's true, you're not. Just realize that whenever you make a decision, you always have to kind of weigh your trade-offs, and your trade-off here is that you haven't covered your Vega risk. Okay. Hopefully that one was answered.
Yep. Rich asked, how do you use at-the-money straddle to assess skew? What does a high or low straddle price indicate?
I don't know who said it before, but if I had to guess, okay, it was probably Dave Stewart. One of the things that if you take a look at, if you constantly look at how expensive implied volatility is at the money, the easy way to do this on here is that instead of looking at just the, taking a look at, can I see it from here, this one? They changed the view on me. What you take a look at is you take a look at what the straddle is. And so if you do this often, okay, you can just do the math in your head, okay? And you know it's 109, 110 bucks, right? I'm sorry, it's about 100, right? $44 and 54. So it's almost 100 bucks. Looking at it this way, there was a way to take a look at over here, and you take a look at a straddle. And the straddle is always going to end up being what each of the right? It's the put and the call. So you can end up taking a look at, and where did we go out here? We went out at 2075. So if I look at 2075, 99.72, right? So if you take a look at what the at-the-money straddle trades for all the time, when volatility is higher, it will cost more. You know, by the way, what Dave's telling you, that was an old floor trader trick. Instead of having to calculate and look at your computer and everything to see what the implied volatility was, you know what? Look at the price. Think about this. Every single thing that we talk about, they're based off of the price. Some people would say that they're derivatives off of the price, okay, because you're doing, you know, calculus to be able to calculate all of this stuff. Why look at all of that? Isn't it easy just to know what the straddle trades for all the time? You know? So that's why some people end up looking at that. And by the way, it's very, very valid. The thing that it doesn't show me the difference between the skew. Now, I could do this, right, if I wanted to. I could say, what's the at-the-money straddle trade for, and what's the $100 below the money, okay, straddle trade for? And I could do the ratio. And you want to talk about, you know, not needing a computer, you can do that, you know. Those of you that are good at long division can do it on paper and pencil. If you have a calculator, you're way ahead of the game. Okay, that's the easy way to do it. So, you know, I could talk to my ex-Goldman partner, okay, who's in charge of trading. You know, hey, look, we could save, you know, $8,000 a month for your fancy box, but by doing this, we do a lot of other stuff with it. But that's one way of looking at it.
Hey, Jim, I know a few people are wondered what the difference between this Kevlar trade that you're doing and Himanshu's.
Himanshu developed a bunch of rules. I had told him what I did and how I did it, and he went off and he did a whole bunch of back testing. You know, one of the challenges that I have always with just back testing or modeling is that if implied volatility, and I'll give you an example, okay, and I know that Himanshu hasn't traded this as long, so it's going to end up being a little bit different for him. But let me come over here and show you day steps again. All right, so here are my day steps. One of the things that I will look at is that if we come in here, I know that those lines, and now I'm not going to get into the difference between Thinkorswim and how much, okay, one line's different than live versus option view. But I know on all of them, especially on Thinkorswim, that this number's kind of lying to me. I know that if we have a quick pullback, that the implied volatility, the way it ends up moving, is going to look a little bit different. Now, some people think, oh, but, you know, on Thinkorswim, instead of looking at open, I'm going to plot out my Vega, okay? And I can see what happens to Vega. And, oh, look at how my Vega is going to become more and more negative as we sell off. And if volatility increases, isn't that going to have a change? And the answer is yes, but not every, remember when we do a vol shock, right, in any type of tool. If I come back over to here, just end showing. And I do a vol shock, and I say, right, and you can do that in here, right? If I say, what happens if volatility goes up 10 points? That's 10 points on everything, on every strike. Now, I will tell you that that will never, ever happen. You'll never have it go up exactly the same on strikes that are, 200 points apart. One of the options will go up more than the other. Some might not end up moving, and it's a huge difference. Now, I can end up getting into the whole vol thing, okay, in terms of how one strike might move versus another, but that's a whole topic until itself. Experience will tell you that volatility will end up helping you, okay, when you're inside the butterfly, especially when you're on the right side of it. As you get below it, you're going to need a little bit more help, okay? Also, I don't know, I know that Himanshu changed some of his rules. We talked about it, and he's had a conversation with me, and I can't tell you, specifically, what he ends up doing when he does it, because this is much more of a take a look at the trade, assess what you're going to end up doing. I tend not to like to pick up my butterflies and have to move them unless I have to. Obviously, we were so far out of this, okay, that I had to. But early in the trade, I'll tend to let things running a little bit more because there are too many times when I've seen, and you saw it on the chart, right? You saw it on this chart. Too many times you have these runoffs only for them to end up coming back, okay, in a few days. So if there is nothing that's forcing me to end up doing this, yes, my theta could be a little bit better. You know what? Let it sit there. Make sure that, it's got its new range. It's run, and then at that point, I'll end up moving. Later in the trade, by the way, you need to end up moving quicker, okay? One of the reasons why I like getting, I start to look to put these trades on, 75 days and in, is that they're very easy to end up adjusting. And if I can end up making, 3, 4, up to 10% in a month with very, very, very little risk, that's pretty nice.
Hey, Jim, I had another question. Is these trades that we're doing, are these hypothetical trades, or are they based on live trades?
These things, I'm giving you the prices that I'm actually getting. I'm giving you a quantity of one. Okay, I'm not giving you my real quantity.
Got it. So these are live trades.
Yeah.
Yeah.
Yes, we do have the option view graphs, but Tom has to show that I don't have option view on this machine.
Yeah, I can show that if you want, but it looks just like this, so just 10 times bigger. Chuck asks, how many trades will you manage at a time while you have overlapping trades?
Great question, Chuck. And here's what I try to end up doing, and everybody's different. Some people like to have on just one. Okay, and if you're going to have on just one, you need to find out where you like to live. Do you like to live in that 75-day down to maybe, 35 or 40-day area? Other people like to keep multiples on. What I like to end up doing is that I never like to have on more than 2. Okay, now here's the challenge with 2. With 2, there's a lot more work because what I do, and everybody's a little bit different, what I do is that I look at each of them, I try to manage them each, what would I do in each of them separately, but then, you can't really do that in real life. So then what I'll do is I'll put them both on the same graph and I'll look at them overall, realizing that the front one may end up moving a lot quicker, right, because there's less time in it. You could do it either way. I will tell you that if I was starting, I would end up thinking that for most people, starting in that 60 to 75-day area, then when you get ready for the next one, take the first one off. Keeping one on is a lot easier to end up doing. There's a lot more to deal with when you have on 2. In addition to that, you also have to end up dealing with the calendar skew, meaning the implied volatility between the first month and the second month, or the second month and the third month, whatever you have on. So you do have to end up dealing with that. I will tell you that some people like to end up trading this in the last 15 days, And you can, but your strategy becomes very, very different. In the beginning of the trades, when you have a lot of time, I don't mind keeping, single points, keeping things relative. As you get closer, okay, I don't buy extra puts in an even trade with a lot of time. I will buy extra puts if there's a lot of time left. I'm doing a broken wing. But later in the trade, you actually have to end up getting extra puts, and a lot of times you already have an extra call. Sometimes you'll need even more calls. So what tends to end up happening if you trade this into expiration, the whole strategy becomes different, and what things happen is that it looks more like an iron condor with a smile face on it. So I'll buy extra puts, and so that as it goes down, it'll curve up, and extra calls, because the whole concept of this is that you don't want to get hurt, right? You don't want to get hurt. And to me, if I'm trading with 15 days, it's great, but you're going to have to make a lot of adjustments. And right now, like I told you, it's I need a trade that has less maintenance. So keeping this putting this on at 75 days, 75 days, is about as far as I would end up going. If I do keep two on, I'll usually only keep two on for, a week or two. Usually most of the month I'll only keep one on.
How close into expiration do you plan on taking these Kevlar trades for this service?
For the service, I plan on keeping on one at a time. There might be some times when I overlap them, but I'm probably not going to. What I'm going to do is I'm going to put them on 60 to 75 days, and I'm going to run them for about a month. Okay, and when the next one gets ready to put on, I'm going to take the first one off.
Easy enough. Chuck asked, excellent answer, thanks. And he said, 2 trades in different months or indexes. Is there typically a time of day you monitor and adjust?
Very, very good question. The answer is that I used to. And a lot of people like to trade. I'm going to use East Coast times, right? So for anybody who's on East Coast, do your math. But I like to trade maybe 2:30 to 3:30. Not 3:30 to 4, because sometimes 3:30 to 4 it's harder to get a fill, and if the market's moving against you, okay, you have to end up chasing. 2:30 to 3:30 is usually, there's enough stuff going on. However, if you're going to end up trading, okay, a smaller number, you can, and there's an adjustment, you can end up trying to put it on earlier. I ended up making these adjustments today. Tom, when I sent them to you, about I probably made them about 2 o'clock today. The market had run up. We had our second leg up, in the afternoon, and at that point I said, okay, you know what, time to start moving this stuff around.
And one thing I found with, say, Brian's Rhino trades, because they're so far out, even if you get a signal that's even a day late, oftentimes you can still get filled at or near the same price.
Yeah, and if it moves against you, you're going to get filled at even a better price, right? That's the whole thing. You never know which way things are going to go.
Okay, so, and Rich just wants you to clarify how many days to stay in the trade. He said open, I think, 60 to 75 and close at about 30 days later.
Yeah, well, probably what I'll end up doing, 60 to 75, and then just minus 30 days, right? That's what I'm going to end up doing for these things. What ends up happening, and here I'll show you this. If I go back to the days, and here's why I think for a lot of people it's better. It's nice, right, because these are 2 weeks, right? So it's easy for us to do the math, okay? So if you take a look at what happens over the next month, right, 14 days, okay, 28 days, and we've been in the trade a little bit already, we're still relatively flat. Look at what happens during the next 2 weeks and then in the last 2 weeks. Well, it's not even quite the last 2 weeks, but close to it, right? Almost 2 weeks. The gamma becomes much, much more difficult to end up managing. That's why the whole trade, and I've done this, before, okay, when I've traded, but the problem is that it becomes absolutely huge. Example, if I end up, people end up having to realize, let's take the date over here. Is this the one? I always forget when I do it this way. No, it's over here. Stock price it used to be over here. Oh, here it is. They moved, right? They've moved the stuff on me. Right. And this is the December trade. So let's just move this up 1 month. Watch what happens to the gamma. It went from 0 to 13. Okay. Look at what happened to my okay. My deltas up. My deltas went from 9.5. I'm sorry, not 9.5. It's not the 11. It's 10. Right. Uh-oh. That's not good. They change rather significantly is the answer. And it's not, I've lost my deltas because right now I had that message. But what ends up happening is that your deltas become much, much steeper, right? Much, much steeper. And let me reset everything. Hopefully that'll work. And then I can uncheck and then recheck. Okay, there we go. So my deltas become much steeper, okay, meaning that the rate of change will be much more, and so therefore you're going to actually have to end up buying some, puts, okay, especially puts, okay, to be able to end up helping. And I need to do that in a broken wing fashion, right? Because the thing is that if I have a broken wing, okay, I have more risk on this, so I have to start to buy them sooner. If I'm doing this from, let's say, starting anywhere from 60 to 75 days, and I'm keeping it on for 30 days, I'm probably not going to have to buy any puts whatsoever on an even butterfly, and infrequently on a broken wing. So, I think that for some people, when they end up trading, they get real comfortable in, and I use the word morph. Okay, if there's a single thing that you have to end up learning, and that's why I keep coming over to here. In the end, it comes down to the price. Right? It really does. So you have to learn how that T+0 line actually morphs. And it won't be exactly like it's planned here, right? Because you know it'll end up being different in real trading. So understand how every day when your T+0 line moves close to expiration, how is it going to end up affecting? On the option view side, I like using that for modeling because it kind of tells you what your Greeks would also be. Okay, on the bottom, if you guys ever see that, I know some people use Option Explorer. That'll do the same thing also. But you can see what your Greeks are going to end up being. And the key is to make sure that you're adjusting. If you go on a trade like this, make sure you're adjusting before T+0 line gets to be too steep. As soon as you get any steepness whatsoever in it, you want it to be as flat as possible. Okay.
We had another question.
We've been going about 15 minutes or so. Go ahead, I'm sorry.
One last question. This trade seems pretty docile when trading two trades. You just look at the trade once a day, i.e. like minimum maintenance. Is that the reason for just two long-term trades, like not a lot of time to trade?
Exactly. Right now, it's I got too many other things going on. I need boring. I like boring.
Well, I think that's it for the questions. So, Jim, really appreciate it. Well, are you going to do any weekly update videos, or like say Amy or whatever at the end of the week, or you're just going to do a couple during the week?
No, what I'll do is that I'll try to end up doing, and we publish those, right, Tom? Those like 5-minute videos. Do you guys like those? Those are easiest for me to end up doing. If you guys like those 5-minute videos, I go through the trade, where we are, what my adjustments might end up being. I'll do 2 a week, except for if I have really rough weeks like this. Then I'll end up trying to plan out. The other thing I'll do for you guys is that anytime I end up making a trade, we made some this afternoon, I'll let you know that evening what I've done. Okay,
great. Well, thanks everyone for sticking with us. I think that's about it, Jim. So thanks again, and have a great weekend, everyone.
Take care, guys.
Okay, bye.